Given that US stocks are in one of the longest bull markets in history, it's reasonable that recent market volatility is making some investors nervous. No one wants to relive a stock market crash if they can avoid it. Given that, while the good times are still rolling, it would be prudent to start thinking about ways to protect yourself against a market crash. One of the easiest and simplest ways to protect your portfolio from a market crash is to hold cash. However, that leads to the question, how much cash should you have? Certainly, the more cash that you hold, you'll be better protected should we see a stock market crash. However, on the other hand, despite high valuations, stocks could certainly continue to rise, and you'll be left with a cash drag on your portfolio if you allocate too much to cash. While the implementation is simple, this question is a little more complex. In this video, I'll walk through several situations and how they might apply to your situation, and how you can use this information to help determine what amount of cash you should hold in your portfolio. At the end of the video, we'll walk through some suggested guidelines from several investors, and I'll share my cash allocation as well. With that being said, we've got a lot to cover, so let's jump right into it. So first off, when I'm talking about how much cash you should have, I'm not talking about cold hard cash like this. What I'm talking about are short-term financial assets, typically referred to as cash and cash equivalents, that are highly liquid and pay a market rate of interest. In this case, to get an understanding of the historical returns cash has provided investors, we'll look at the 3-month Treasury bill yield, which is a good approximation for the returns that an investor could get on cash. Now, back in the day, the returns you could get on cash were actually relatively reasonable by historical standards. In today's low interest rate environment, it seems crazy to think that you could have gotten 5, 6, or even 7, 8% just by sitting your money in a bank. Fast forward to today and this most recent decade post the financial crisis, and interest rates on cash have been stuck at 0 and only have just started increasing as of 2016. Now, while you can get around a 2% annual return today by just holding cash, that's still very low by historical standards and is why many people have a negative opinion on cash. Add to that, those yields I shared with you are nominal yields, meaning they don't take into account the negative impact of inflation. While you might be getting a 5% return, if the prices of all goods around you raise by 5% as well, you've not improved your financial situation at all. This has been the story with cash, particularly as of recently. The average historical return for global cash has been around 3.8% per year. However, when you subtract out 3% inflation, that turns to a real yield of less than 1%. And in addition to that, around a third of the time, your cash will actually have a negative real return, meaning that you'll be able to buy less next year than you could today for the same amount of cash. We can take this into consideration taking a look at the Consumer Price Index. Now, if we plot that against our cash yield in red, you can see historically there have been periods where cash has gotten a positive real return. However, as of this most recent decade, cash has been losing value to inflation each year. Here's the real return of cash, which is basically our 3-month Treasury bill rate minus our Consumer Price Index, or inflation. As you can see, past 2009, we've had a negative real return on cash for the last 10 years. So why would anyone want to hold cash at all if you're just going to lose money every year? Well, I'll give you 2 benefits. One of them is it helps reduce the volatility as well as the risk if you experience a down market. And the second is closely related, and that gives you the option to invest in some really great opportunities that can occur following a market crash. Regarding the ability to limit downside risk, this chart shows you the best, worst, and average returns for various stock and bond allocations over the past 100 years. In this case, this is looking at relative proportions of stocks to bonds in the portfolio, but you can think of the bond portion as an equivalent cash portion for this analysis. The numbers will be slightly different, but the trend is the same. In this case, designated by the red bar, there's significantly more risk and volatility with a 100% stock portfolio, but it has shown, on average, a historically higher rate of return. On the other hand, on the blue end, if you do a 100% bond or cash portfolio, the volatility of your annual returns is much less, but then again, your average rate of return is much less as well. So somewhere along this spectrum will be the answer for you in terms of what is the optimal trade-off between risk and return that you're willing to have in your portfolio. Keep in mind that we are in one of the longest bull markets in history, and we haven't yet seen any serious negative returns like the ones shown below. Given that, you have to ask yourself, is it worth maybe giving up 1% of annual return a year to save and protect yourself from a serious downside loss? Again, that'll be a personal decision up to you and your risk tolerance, but it's something to consider. Now, during a market crash, having cash gives you the option to take advantage of great opportunities, both in value stocks and growth stocks. If you take a look at the stock price of Google before the crash, it was around $360 per share. At its market bottom, it dropped to $142 per share, well over a 50% decline. Now, one of the reasons why I like value stocks is because I don't want to pay too much for a company, and I like having a margin of safety. However, if we were able to see a similar style crash of Google stock today and it dropped below $600, you bet I would be picking up a lot of shares. Just keep that in mind, because if you had held some cash at the end of 2007 and were able to purchase near the lows in 2008, you would have effectively gotten a 100% return on your cash, because at that point you could then buy twice as many Google shares. That's the kind of power that this stuff has during a crash. Now, one reasonable response would be, well, you don't know exactly when the market bottom is going to be. And that's a very fair question. It's one that I don't know the answer to, and no one else does either. However, given that, there are strategies that you can implement during a crash to make sure you're using your cash effectively and capitalizing on some of those opportunities. One of the simplest ways is a simple tactic called rebalancing. In this example, if you want to have, let's say, a 60% allocation to stocks, if you don't rebalance or just make your initial allocation, over time, your portfolio allocation will drift. In the case of bull markets, it'll be more weighted towards stocks, which will increase your risk should you see a market crash. If that's the case, your portfolio will fall more than if you had rebalanced or taken a portion of some of those stocks, sold them, and moved them over back to cash to maintain your set allocation of stocks. In this case, it was 60%. This works the other way as well. So if your allocation drops below 60% in a market crash, use that cash to bring that allocation back up to your target allocation and put some of that cash to work buying valuable companies at a discount. And for reference, the graphs I'm sharing here are from Vanguard's Principles for Investing Success, a free PDF that you can download online. Another important lesson to know is that having allocation to cash is more important at market peaks and more detrimental at market bottoms. In this case, after the financial crisis, if an investor got scared out on losing any more in losses and went to fully cash, by that time it would have already been too late. That's the time where you need to be redeploying that cash and capital into stocks that are undervalued in the market. If seeing market declines and increased volatility now while we're still at the peak of a bull market makes you nervous, consider increasing your allocation to cash now to avoid making an emotional mistake and selling later down the road after you've incurred significant losses. And finally, one of the most important lessons, but one that's not really talked about a whole lot, is that honestly, your investing returns don't make that much of a difference in terms of your total wealth over time. That is, at least compared to how much you actually put into your investment accounts and how much you're actually saving each month. In this example, assume a person had $10,000 to start out with and invest $5,000 every single year. This bold beige line represents if you continued that $5,000 per year savings rate and got an 8% return in the market. However, if you're able to increase your savings rate by just 10% to $5,500 per year, even if your rate of return was as low as 4%, you'd still end up doing better as shown on this red dotted line. So if you're really concerned about a market crash, you'll want to start saving more. This will have a huge impact over time, especially if you're able to deploy those savings at opportunistic times in the market. So in the meantime, you've saved up some cash and decided on your appropriate cash allocation. So from there, where should you be holding your cash? Well, one option is simply in a bank savings account. Some online savings banks typically offer higher rates of return. For instance, Ally Bank offers currently 1.9% yield on savings accounts. However, if you're also willing to look at money market funds, there are other options available to you as well. In this case, I'm looking at the Vanguard Prime Money Market Fund, ticker symbol VMMXX, which is currently the fund I'm holding my cash allocation in. Right now, I'm getting a yield that's better than most savings accounts. Currently, the money market fund is yielding 2.15%. If you're not familiar with them, the way money markets work is that they invest in very short duration bonds, typically called commercial paper. In this case, compared to bonds that last years or decades, these agreements typically last 3 months or less. So we've covered some of the considerations that can help you decide how much cash you want to hold in your portfolio. Now let's explore some examples of what is standard in the industry as well as what some other investors are doing. And at the end, I'll share what I'm doing as well. So if you have a 401k at work, it's possible you're offered what is called a target date retirement fund. These funds are effectively an all-in-one solution that has both stocks and bonds in one fund. The objective of the fund is to maintain a steady balance of an asset allocation that will gradually shift to more conservative as you age. In this case, Vanguard has 12 funds broken out by age bracket. The funds start off aggressive, having more assets in stocks and less in bonds, and then gradually as you age, it shifts to an allocation that's more in bonds and less in stocks over time. In the most aggressive target date retirement funds, Vanguard allocates a 10% allocation to bonds. Personally, I see this as rather aggressive and think most investors would benefit from having at least 10% of their assets in bond or cash-like equivalents. Again, going back, having a 100% stock portfolio leaves you with a significant amount of downside risk should things go south. So 10% gives most people an aggressive lower limit, but what about a more conservative estimate? In this case, we'll look at the recommendation from Benjamin Graham, the author of The Intelligent Investor. If you, for some reason, don't have this book, I'll leave a link to it in the description below. It will pay itself back many times over and will likely be one of the best investments you make. So understand that this is conservative, but Graham recommends for most people starting with a 50-50 stock to bond allocation. Given that, you could shift as far as 25 to 75% in either direction, depending on if you thought stocks were over or undervalued. Graham explains the sound reason for increasing the percentage in common stocks beyond 50% would be the appearance of, quote, bargain price levels created in a protracted bear market. So these would be the market crashes that we're trying to protect ourselves from. Examples would be the dot-com bubble of 2000-2002, as well as the financial crisis from 2008 to 2009. Continuing on, conversely, sound procedure would call for reducing the common stock component below 50%, when in the judgment of the investor, the market level has become dangerously high. If you haven't seen my video, 3 reasons why the stock market could fall 20% or more, I lay out a few reasons why I think there's an argument to be made that valuations are high. Now, while I don't think most investors, myself included, would be willing to go down as little as 25% stocks and have the remainder in bonds or cash, understand Graham's underlying message here in this statement that investors should be cautious when market valuations are elevated. Benjamin Graham was an exceptionally successful value investor, so let's take a look at the portfolio of one of his students. So it's been talked about in the media for a while now, and it's no secret that Warren Buffett has been accumulating a relatively large pile of cash. The implication being that it's difficult for Buffett right now to find very compelling value opportunities within the market. Let's take a look at Warren Buffett's company, Berkshire Hathaway, and its investment portfolio on the balance sheet. In this case, these first 2 rows are cash and cash equivalents, as well as short-term investments in US Treasury bills. This is effectively Warren Buffett's cash position that he's holding. In addition to that, in his portfolio, he also has some investment in bonds, and then he has his stock investments, which also includes his stake in Kraft Heinz. So from these numbers, he's got over $1 billion in cash, but let's take a look at that in context of his entire portfolio. Looking at the graph at the top, we can see Warren Buffett's full portfolio allocation. In this case, as of the most recent quarter, if you include his interest in Kraft Heinz, Warren Buffett has roughly a 33% allocation to cash, or about a third of his portfolio in cash, and then a 6% allocation to bonds. This means in total, his portfolio is about 39% cash and bonds and 61% stocks. Now, if you go to the graph directly below and exclude the Kraft Heinz investment, the percentages for cash and bonds increase somewhat, but you can generally think that Buffett is around 40% cash right now. Now, I made a mistake, and this should actually be Q4 2017, but if you'll notice that from 2 quarters ago, Buffett has actually increased his allocation to stocks slightly by about 2%. Given that, he still holds a very significant cash position. With all that being said, it is important to note that Buffett, because his company is an insurance company, they do need to have some amount of reserves on hand, which is cash available to pay insurance claims in the future. Buffett has stated he'll want to hold at least $20 billion worth of cash at any given time to help cover these claims should they come up. This slightly reduces the amount of cash Buffett has to invest. However, there's still over $80 billion that Buffett could put to work should we see a market crash. So when you see one of the world's greatest investors being conservative and hoarding cash, I think it's something to take note of. With that being said, what am I doing and what does my portfolio allocation look like? So I actually ran the numbers this morning and was a little shocked at what I found. What surprised me was just how remarkably similar my asset allocation was to that of Buffett's. Now, my goal is not to copy Warren Buffett, but I'll share a bit about my process for selecting my asset allocation. Going into the year, I was targeting roughly a 50% allocation to stocks and a 50% allocation to cash and bonds. Throughout the year, I found a few compelling value investments, which I've discussed on this channel, and so my allocation to stocks has increased because of that. I'm comfortable with where the portfolio stands right now, though I do have plans to exit out of a couple positions in my private portfolio at the beginning of next year. This will likely bring the allocation closer back to 50-50. Now, if I see more compelling value opportunities in the market, I may bring that percentage allocation to stocks back up again. However, the main reason why I'm holding this large cash position is to be prepared to take advantage of those really exceptional value opportunities that only come during periods of market volatility. I'm fully aware and accept that this large cash position could be considered by some as a drag on the portfolio, especially if indices continue to keep rising. Overall, I hope this transparency helps you understand my thought process. Ultimately, how much cash you hold is a personal decision, and it's up for you to decide for yourself. But hopefully this video gave you some additional perspective that can help you answer that question. If you haven't already subscribed to the channel, you can click my face to do so, and I'll have a recommended video for you here in just a moment. Until next time, thank you for watching. My name's Michael, and I will see you in the next video.